Welcome to this deep dive. Today we're digging into AFL Incorporated's first quarter 2025 earnings call.
That's right. We're looking for those crucial insights for experienced investors trying to get past the headline numbers.
And it was definitely a mixed picture this quarter. Net earnings per share were way down at $0.05.
Yeah.
That was mostly due to investment losses, a big swing from last year's gains.
Yeah, but the adjusted earnings, the number they often focus on, that landed at $1.66 per share, pretty much flat compared to last year.
Okay, so flat adjusted earnings.
Yeah.
But the real action seems to be happening in their different markets, right? Japan especially.
Absolutely. Japan saw a really strong sales growth, up 12.6% year over year. That's quite significant.
Wow, 12.6%. What's driving that?
A lot of it seems to be their Sumitas product and also a decent rise in cancer insurance sales, up about 6.3%.
Okay, Sumitas. We also saw some growth in the U.S., though, maybe not quite as dramatic.
Correct. The U.S. side was up 3.5%, still positive momentum, particularly in group life and disability, and also their network dental business.
Got it. So let's maybe dive deeper into Japan first. That 12.6% increase really stands out.
It really does. And what's interesting is the strategy behind Sumitas. It looks like it's genuinely connecting with a younger audience there.
Which is often a tough nut to crack for insurers.
Exactly. And the plan, it seems, is to eventually cross-sell these newer, younger policyholders into their core medical or cancer policies down the line.
Makes sense. Build a relationship first.
Mm-hmm.
And they also launched a new cancer product, Mito.
Yeah, Mito. It had an initial launch in March, and they said the early signs were positive. The full rollout across all their sales channels finished up late April.
So it seems like a multi-pronged growth strategy in Japan.
Definitely. They're looking to keep that third sector sales momentum going.
And it's not just about getting new customers, is it? They seem pretty good at keeping the ones they have in Japan. That persistency rate looked high.
Remarkably high, 93.8%. That essentially measures how many customers stick with them year after year.
That really speaks volumes about their brand and the value people see in their products over there.
It does. It's a huge factor for stable long-term revenue, especially when you need to offset policies naturally running off or, reaching paid-up status.
Although, didn't they treat the definitions lightly?
They did mention that, yeah. They no longer count policies moving to an annuity phase as a lapse. That added about 30 basis points or so to the reported rate. Still a very strong underlying number, though.
Okay. Now, what about profitability in Japan? Sales are booming, but you mentioned the overall adjusted earnings were flat. How did the Japan segment margins look?
Right. So there's a bit of push and pull here. On the plus side, their benefit ratio, the amount paid out in claims versus premiums collected, actually improved. It dropped to 65.8%.
Lower is better there.
Exactly. Where 120 basis point improvement. Part of that was due to these remeasurement gains, but also favorable underlying trends in cancer treatment costs and hospital stays seem to be helping.
Bet. There's always a bet.
But their expense ratio went the other way. It increased to 19.6%, up 160 basis points. They flagged higher tech spending as the main reason.
Investing in the future, perhaps?
Presumably. And on top of that, their adjusted net investment income in yen terms was down 7.6%.
Ouch. Why was that?
Mainly lower income from floating rate investments, plus some impact from transferring assets for reinsurance purposes. They did get some help from structured private credit returns, but not enough to offset the drop.
So better claims experience, but higher tech costs and lower investment income.
Exactly. Which nets out to a pre-tax margin in Japan of 31.8%. Still very strong, objectively. But it was down 100 basis points from the year before.
Still, it sounds like they're the dominant player there, especially in cancer insurance.
Oh, definitely. They have the largest share of new cancer and medical policies based on the last fiscal year data, and they fully expect to hold on to that lead.
Even with more competition.
Yeah, they acknowledged competition, especially in cancer insurance, is heating up. But they point to their, 50-plus years of experience and unique customer service as differentiators. The medical side is apparently even tougher, requires more frequent product updates.
Okay, let's switch gears to the U.S. then. Sales up 3.5%, you said. What's driving that?
Mostly momentum in group life and disability, and also network dental. They seem focused on Profitable growth, emphasizing strong underwriting.
Which seems to be paying off and keeping customers too. Persistency was up in the U.S. as well.
It was up 60 basis points year over year to 79.3%. Not quite Japan levels, but definitely a positive trend.
And the profitability story in the U.S.?
Yeah.
Similar dynamics to Japan or different pressures?
A bit different. The U.S. total benefit ratio actually increased to 47.7%, so up 120 basis points.
So paying out relatively more in claims.
Yeah, partly due to the mix of business they sold and also lower remeasurement gains compared to the prior year. Though they did note claims were still coming in below their long-term expectations, so that gain still helped by about 100 basis points.
Okay. Any bright spots on the claim side?
They did mention favorable underwriting results in their long-term disability block, which is small but growing.
And expenses in the U.S. Did they see the same cost pressures as Japan?
Actually, the opposite. The U.S. expense ratio improved. It came down to 37.6%, a drop of 110 basis points.
How'd they manage that?
Mostly platform scaling, getting more efficient as they grow, and just general cost control efforts. They did say some growth initiatives, like in group life and dental, added about 50 basis points to expenses, but that was expected.
Okay, so U.S. expenses look well managed. Investment income.
Similar story to Japan, unfortunately. Adjusted net investment income down slightly, 1.9%, again, mostly due to lower floating rate income.
So putting that all together for the U.S. margin.
Profitability still looks strong. The pre-tax margin was 20.8%, just a small dip, 20 basis points year over year, so pretty stable performance overall.
And you mentioned investments earlier. It sounds like they're actively managing potential risks, especially in real estate.
They are. They specifically mentioned increasing their reserves, their CECL reserves for potential losses on commercial real estate loans by a couple million.
Proactive measure.
Yeah, and they also foreclosed on 2 loans, taking ownership of the properties. They said that's part of their plan to maximize the recovery value if things go sour. Their middle market loan portfolio seems okay, but they bumped up reserves there too, just in case.
Okay, stepping back to the overall company picture. How's their financial health capital situation looking?
Pretty solid, it seems. Adjusted book value per share, if you strip out the currency noise, was up 2.2%, and their adjusted ROE, return on equity, was 12.7%.
Which is decent. And they're still returning cash to shareholders.
Oh, yeah. Big time. In Q1 alone, they spent $900 million buying back their own stock and paid out $317 million in dividends. That's $1.2 billion returned in just 1 quarter.
And keeps that dividend growth streak alive. How many years is it now?
42 consecutive years of dividend increases. Quite a track record.
Wow. And their safety net, liquidity, capital ratios.
Looks strong. They have $4.3 billion in cash at the holding company, which is $2.6 billion more than their minimum target. And all the key regulatory capital ratios, SMR, ESR, RBC, are well above required levels. Looks like a robust capital position.
What about debt? Leverage.
Leverage was 20.7%. That's comfortably within their target range of 20-25%.
And that's affected by the yen, right?
Significantly, because about 59% of their debt is actually denominated in yen. So when the yen weakens against the dollar, their reported leverage goes down, and vice versa. It's an intentional part of their structure.
Do they quantify that FX impact?
They do. They estimate that every 5 yen move against the dollar impacts their underlying EPS by roughly 7 cents. So it's not insignificant.
So how do they manage that currency risk? It sounds like a big deal for them.
They have a multi-layered approach. They hold a huge chunk, like $25.5 billion of unhedged US dollar assets in their Japan General account. They also use forward contracts, issue debt in yen, as we mentioned, and even use out-of-the-money put options to protect against the yen suddenly getting much stronger.
Sophisticated stuff. Did they mention any impact on their capital ratios from FX this quarter?
Yeah, they noted a small dip in their ESR. That's a key solvency ratio in Japan. They attributed it partly to the yen strengthening during the quarter. But it was partially offset by higher interest rates in Japan and also helped by dividends flowing up from the Japanese subsidiary. They emphasized it's all part of their long-term hedging and capital plan, where they run lots of scenarios, including stressed ones. That FX hedge program on the ESR is specifically designed for risk management.
All right. Now, for that part of the deep dive where we remind everyone this is purely informational discussion, definitely not financial advice.
Absolutely not advice. But okay, let's brainstorm a really speculative, maybe even slightly crazy trade idea based only on what we heard in the call.
Okay, lay it on us. What's the speculative play?
All right, so AFLIC has tons of capital, right? They're buying back stock aggressively, and Japan sales are booming, especially with that Sumitas product hitting the younger market.
Okay, following so far. Long AFL stock seems logical if you believe that continues.
Right, that's the core idea, long AFLAC. But here's the wilder part. You hedge the currency risk and try to leverage the Japan story further. Management explicitly talked about yen volatility impacting earnings and capital ratios.
So, hedge the yen. How?
Well, one way, maybe, could be simultaneously buying some out-of-the-money US dollar Japanese yen call options. Let's say with an expiration a few months out.
So, betting the dollar strengthens against the yen.
Exactly. If the yen weakens, that could boost the dollar value of their Japanese earnings when reported, potentially helping the stock. The calls give you leveraged upside on that currency move.
Interesting angle. You mentioned leveraging the Japan story further, too.
Yeah, maybe, and this gets even more speculative. You could pair the AFLAC long and the USD JPY calls with maybe a long position in a broad Japanese equity index ETF.
Whoa, okay. What's thinking there?
The thinking, purely hypothetical, is if AFL's strategy really works well, driving significant growth in Japan, maybe that contributes to broader positive market sentiment over there. A rising tide lifts all boats kind of idea, but obviously that adds a whole layer of general market risk.
So long AFLAC, long USD JPY calls, long Nikkei ETF, that's a complex position.
Highly complex, highly speculative. Lots of ways it could go wrong. Could lose the whole investment. It's purely a thought exercise based on the call's themes. Again, not financial advice. Do your own homework. Talk to a professional.
Definitely noted. A very creative scenario, though. Okay, well, that about wraps up our deep dive into AFL's Q1 2025 earnings call.
Yeah, we've hit the key financials, the strategies in Japan and the US, how they're managing capital and FX.
Hopefully breaking it down like this provides some useful context. What are your big takeaways? That Japan youth strategy seems pretty key.
It does, and watching how competition plays out in the US, especially in things like dental, will be interesting too.
For sure. We always encourage you to continue your own research and analysis. Thanks for tuning into this deep dive.